IPOs look hot. Don't touch them. You could get burned. So far, in 2025, there have been over 150 IPOs, which if you're not familiar with the term, it stands for Initial Public Offering. These IPOs have raised about $29 billion so far this year, and it's a nice increase in the total number of IPOs when comparing to recent years. At this time last year, just 99 IPOs had occurred, and in 2023 it was even lower at 76. The exciting news reads, first day gains are averaging 26%, which is the best since 2020. But it's important to understand that those eye-popping first day gains are not based off of the first public trade, but rather are gains on shares that were issued prior to coming to the market. Unfortunately, you as an investor have little to no chance of getting those shares, as you generally see these go to your institutional investors and high net worth clients of big firms like Fidelity, Charles Schwab, and the other big firms. So if you can't get the shares before they begin trading, is it worth riding the bandwagon? I'm going to explain the answer to you, but it is a solid no. First off, take a look at an ETF called Renaissance IPO. Back in 2021, it hit a high of around $75 a share. And by 2023, it fell to about $25 a share. With the recent frenzy in IPOs, it has climbed back above 50, but that is still a disappointing return to say the least. Also, this means any investors who bought it in 2021 through 2022, well, you're still probably sitting underwater. There is generally a ton of volatility around these trades, considering when companies do an initial public offering, they're only releasing many times 15 to maybe 20% of their equity, and they often come with an initial lockup period of around 180 days, which really reduces the amount of shares that are trading, hence the high volatility. Also, make no mistake that the investment bank that's issuing those shares has an obligation to try to get the opening price as high as possible to get full value for their clients. If it's an oversubscribed IPO, the demand will be higher than the supply and the price will rise. Unfortunately, that means the company left money on the table that they could have put in their pockets rather than let investors benefit from those big gains. I do believe investing in IPOs is a high risk game not to be played with by the average investor. Let me give you a good example. Newsmax, which was a hot IPO with an issuing price of $10 a share, that very quickly went to $265. As of today, it is trading around $13 a share. Huge decline. A lot of people have lost their shirts, and I doubt they'll get them back. To me, the safer play to benefit from the increased number of IPOs is the banks handling this process, considering they should be seeing a nice increase in their profits. This would include your large players like JP Morgan Chase, also Goldman Sachs. And as of now, there are other anticipated IPOs that could occur over the next year with names like robo-advisor Wealthfront, crypto firm Grayscale Investments, financial technology firm Stripe, and sports apparel and betting company Fanatics, all potentially hitting the public market. I'm Brent Wilsey, and I'm with Wilsey Asset Management. If you like these videos, well, be sure to give it a like or comment, and feel free to check out our other YouTube videos. And don't forget about the weekly newsletter, a lot of great information there for the latest economic news, expert analysis, and market insights.